Don't go away. We have a session coming on straight away, led by Hendrik de Troyes, the CEO of my bank, Investec Asset Management.
Ladies and gentlemen, now that we all have seats, and you don't need those earpieces anymore, I'd like to, without much ado, because we have a big panel, a big topic. I think Michael has changed that the Michael Elliott, the editor of Time International and deputy managing editor of Time magazine, I think he's changed it over lunch. He said finance and the future. So we're going to talk about finance and the future. There's a very large number of you who know a lot about finance, starting with Mr. Trevor Manuel, right through to the heads of a number of big South African organizations. By the way, I am not responsible for running a bank. I look after the fund management business of Investec, much more simple business. But we have a wonderful panel starting with Joseph Ackerman, the chairman of the management board and group executive committee of Deutsche Bank, a truly universal bank which does both investment banking and commercial banking. Shaukat Aziz, the former prime minister of Pakistan, also someone who has been a banker for a long part of his life. He probably knows as much about Citigroup as many people who are there today. And we have the chairman of Citigroup, Dick Parsons, who's a great friend of South Africa. Thank you very much. You stepped from a very calm industry, the media industry, into this world. Enjoy it. Nicholas Stern, who is not only a very accomplished economist, but also now Mr. Climate Change, so you can give the banks trouble from both sides or the financial institutions. But Nick is a very, very good commentator, and we appreciate your time. And then lastly, and most importantly, Meredith Whitney, who predicted the collapse of the banks. And as far as I've discovered over lunch, has not yet that bullish about the financial sector, so we'll have a very interesting discussion. But before, Michael, before you start, I just want to hand each of the panelists, and not the chairman, you'll get yours later because we didn't know there were so many panelists, a vuvuzela, because you should all go back to your various sectors, and when your regulator talks to you, please take the vuvuzela with you. It has a zebra. And there's one for Michael as well, I think. Thank you very much. May the panel enjoy the discussion.
Thank you. Thank you very much, Hendrik. I have my own personal vuvuzela, which I left in the green room, actually. I used it at the session that I chaired a couple of days ago to kind of keep everyone in line. So I know how to use them. I'll blow it if you go over. It's terrific to have such incredible talent on international finance on the panel. I'm sorry, we're obviously running late, so we're going to have to be both brilliant and brief. Joseph, we've had two and a half days in which we've discussed the world's economic problems. We've discussed the potential for growth in the developing world, the new global opportunity, as we've called it at the conference. We've got 2.5 days in, and we haven't mentioned Europe and the possibility of a sovereign debt crisis. And I was anxious that our audience should not leave before we had some sense of how serious you see the problems are in Europe, and then we can broaden this out, and we can talk to Dick and Meredith about the potential for knock-on effects, contagion effects in the US. We'll get Nick looking at the global economy and Shaukat as a whole. But give us a quick snapshot of where we now are.
Thank you, Michael. Well, when the topic is finance and the future, I would start by saying Europe has a future. And let me just say 4 things. If I was a CEO of a company trying to market Europe with investors in South Africa and Asia and in the Middle East, I would probably get 4 questions. The first question is Europe united, or are you having different agendas? The second question would be, you are talking about cost cutting, speak budget reduction, are you going to deliver? The third question would be, there are a lot of issues around banks. What is really happening? Are you as weak as some people say? And the fourth, how can you survive with one currency, one monetary policy, several fiscal policies, and several economic policies? Let me quickly give the answers. The first, I think, since May 9th, with this huge several hundred billion package, European leaders have clearly demonstrated that we are behind the euro and behind Europe and that we are united. Secondly, talking about cost cutting, if you listen today to the prime ministers of Greece, of Spain, of other countries, and you hear how serious they are in also putting at risk their own re-election, their own professional and political career, you start believing that these goals will be achieved. The third is transparency. We will have stress testing and we disclose it, probably more than 100 banks in Europe. And I think that's a very important message to the world, that we are willing to do tough stress testing and giving the results to the public at large. And the fourth, I think we have to go back to a very disciplined approach in terms of adhering to the Maastricht criteria, and probably also have to talk about more coordinating economic policies. But all these 4 points, which are the most critical questions someone selling Europe or marketing Europe to investors would get, I'm confident that we can answer them very positively. So yes, Europe has some difficulties, but still, if you talk about debt to GDP, we are much better off than the UK and the United States, just to make that comparison at the end.
Nick Stern, are you as positive?
Yes, but I would stress the underlying reason for being positive is political. I mean, the European Union grew out of the iron and steel community and the European community because after the Second World War, Europe understood that unless it got together, we would possibly face the same kind of travails we'd faced over the previous 100 years of essentially fighting each other. And that sense of history is absolutely fundamental, and the euro represents the European project. And if it fell apart, the political fallout, as well as the economic fallout, would be profound. And that's why I think I would go with Joseph on the commitment of the leaders of Europe to making it work. It's in large measure political, and the same politics that drove the whole beginnings of the story in 1950.
Showkat, our bankers, are former Citibank executive, of course, and someone who travels all over the world, are bankers and finance ministers looking at Europe nervously, or do they think, as both Joseph and Nick seem to suggest, that the key decisions have been taken and everyone can relax?
I agree with both the comments, but I have some other comments, which is that I think this is, on a serious note, this is a wake-up call for Europe and the world. I think Europe has a great future. It has countries with a lot of strengths. But I do believe that fundamentally something went wrong, which created the current situation. And I see even today a disconnect between fiscal policy and monetary policy and overall economic policy. Whether it's the EU or the European Central Bank or somebody else, there is lack of one voice on who looks at Europe as a total economy. And I understand what happened at Maastricht. I'm a great believer in the political benefits of a united Europe, but I think more needs to be done. Yeah. So with due respect to all my colleagues here, I would say that the current structure as it is could give rise to, again, problems of a different nature. And if you allow me to take this just to the whole world, today, in my view, one of the reasons the whole world is facing these problems is there's lack of coordination and lack of a single voice. Name me one leader in the world, either a country, running a country or running a multilateral institution, who's looking at the world totally and driving this change. So I don't see that. So I see a bit of a leadership void. And coming to banking or finance, which you referred to, just one line, I see a lot of smart people in banking. I've been in it for 30 years. I was one of the few who was not smart enough to stay there. But I see lack of wisdom in the financial sector, present company excluded, because it's not smarts alone which will get us there. We had great people who could design any product, sell any derivative, take any positions, make a lot of money for the company. Nothing wrong in that. But there's more to life than that. And I think the wisdom factor is lacking in the banking system today.
Dick? A wise man.
There's no connection between what Shaka just concluded with and you're calling on me, I hope.
Not at all.
Well, it's interesting. I agree with everything that's been said so far, with one exception, which I'll get to, but I'd put the accent on a different syllable. The one thing I don't agree with is I think I heard Joe say at the end of his defense of Europe is that the European Union is probably in better shape than the U.S. and parts of Asia. I don't agree with that. I think the U.S. continues to be in the best shape of any country in the world. Doesn't mean we don't have problems. Doesn't mean that I mean, you want to talk about lack of wisdom. It's not just in the financial sector. It may be in much of our leadership right now across the board. But those are remedial problems. And my own view is I do think Europe comes out of this. It's very important. Obviously, all the markets are sort of looking at that right now. But one thing we learned, or at least I learned, and I hope others learned it, in the last crisis is that, yes, it's a lot about quantitative things, but it's primarily more about psychology. It's more about how people think and feel, their sense of comfort, their sense of optimism, their sense of is there a future? And that's where I think the U.S. is not only financially still the fat kid in the boat, but from a point of view of temperament and resilience and confidence, still the fat kid in the boat in terms of pulling the world forward. And while I was saying to somebody over breakfast this morning that it's almost, even though job creation has not reignited in the U.S. yet, and even though housing prices are still falling, it's like the consumer they've had it with being afraid. They've had it with being sort of intimidated by global forces, and they're Americans. They just can't wait to spend again, and they're going to start. And that's going to drive a lot, in my judgment. But now we're about to hear from Meredith, I'll bet.
Well, now we are going to hear from Meredith. Two questions, actually. First off, although we've got used to thinking of the sovereign debt crisis as a European crisis, as you and I were discussing over lunch, state and local governments in the US have their own very serious debt crises, and I know you've got thoughts on that, and in particular, whether they're being taken seriously enough. But what I think all the gentlemen on the panel really want to hear from you about, Meredith, is whether you think the banking industry is full of wise men or not.
Smartness comes in a lot of different varieties, right? With respect to the US, what is so interesting in terms of the comparison with Europe is that Europe has a timetable only when the market tells it has a timetable. The US has a timetable as of this week. So 49 states are constitutionally required to have balanced budgets, and 48 plus states have massive imbalances. So what that means is you're going to have austerity measures taken just at the time when the government traditionally uses hiring and spending to fuel the economy out of a crisis or a downturn. And I think that has very underappreciated implications and will have very serious consequences to the extent that state and local governments employ 20 million Americans, or 15% of the US working class. Now, to say whether this is appreciated, the rating agencies have not reassessed some of the states in a decade. And so when we talk to the rating agencies about, are they worried about this? They say, well, and even some of the top firms covering this market, municipalities don't go broke. I mean, after all, they haven't in 20-odd years.
So are you
like
seeing
housing couldn't go down on a national basis because it hasn't since the Great Depression.
Are you seeing the same behavior of rating agencies in relation to muni debt as you memorably saw when people were doing crazy derivatives 4 or 5 years ago?
Without a doubt. And then if you look at the investor base of muni debt, the largest investor base is you and me, households. And then you go to the second largest investor base, which is insurance companies. And households think, it's AAA rated. All of this sounds so reminiscent of buying a AAA rated mortgage-backed security. And so the complacency surrounding that area is haunting, and it's so recent too.
And sorry, Nick, did you want to come in on this?
I think it's important to see the analogy with Europe there too, because what we're risking now in Europe is a coordinated mass cutting of the deficits. And you can't rely as a member of the Eurozone, or even the UK, on a great burst of external demand carrying you out of the deflation created by a cutting in the deficits. And I was with Prime Minister Zapatero of Spain about 3 weeks ago, when they were just trying to get through some of their reforms. They've got 20% unemployment, 40% youth unemployment. They're slashing back on their deficit, and 70% of their exports go to Europe, which are doing exactly the same thing. So you've got a real problem of translating this European solidarity idea, which did get a boost as a result of the crisis, into sensible, measured fiscal policy. It's crucial to cut the deficits, but the pace at which you do it, whether you get some other growth force driving it forward, I actually think it's the new energy industrial revolution that should do that. But we do risk in Europe a mammoth cutback all at the same time, and actually making it very difficult for that reason to cut the deficit itself.
Meredith, I want to bring you back to the second question that I asked you, because Showkat nicely set up the idea of the finance industry as being full of wise men. You've kept a pretty close eye on these wise men for the last 4 or 5 years. Well, for much longer than that, but in particular as the crisis developed over the last 4 or 5 years. Do you think it's an industry full of wise men?
I think the industry has been comprised of men and women in a very good environment for a very long time. So they were very slow to, actually didn't adapt to change. A lot of the managers of these firms that were creating products that they weren't aware of. So they had been so far away from the production line that they just sort of lost touch of what the business was doing. And remember, another issue in the States is that bankers have not worked alone in 20-odd years because the environment has been spectacular. So they've gotten away from their core skill set of making a loan and collecting that loan. So wise in ways that are, in many cases, antiquated and are not what we need for the current environment. I'll give you another example. So many of the banks have been under such duress, they've been playing a game of defense for 3+ years. And so you see an environment that's going on in front of us, which is the debanking of the US population, whereby you have emerging wealth that's underbanked, moving to prepaid services, and moving, the whole payments industry globally is changing dramatically, and many of the large banks are not participating in that radical change. So the defensive posture, I think, puts them even further behind, so that when this is banking, when the smaller players, which have an opportunity to compete with these Goliaths for the first time, really make strides, it may be too late for these big guys, so they shrink dramatically.
Showkat, and then both Joseph and Dick want to come in.
Yes.
I got to defend the bankers.
You mentioned smarts and wisdom. I won't repeat what I said earlier, but I would say that I agree with what Meredith said, that as the growth came in financial services, greed, arrogance, and lack of basic knowledge of banking became very prevalent. In a boom, when everything is moving in the right direction, you make a lot of money. That's when you get blurred vision. There are many CEOs of banks today who have never made a loan in their life. There are many members of boards who have not, maybe they shouldn't be bankers, but who have never made a loan in their life. So when you come to a crisis mode, you need all hands on deck. And that's where, what I meant by smarts and wisdom, that's where I separate the two. So what we need in banking is a balance. We went a bit out of balance. And we were designed, the banking structure and the people placement was designed for bullish markets. When markets contracted, there may be exceptions, of course, but when markets contracted, many of the people who were on deck didn't have the skills to deal with the crisis. And that is really, that applies to regulators. I'm all for proactive regulators. You can't wait for a quarterly report and look at it and see if the bank is doing all right. You have to preempt, you have to understand the strategy. How many regulators spend a quarterly review with the CEO? Maybe now they do. In the old days, it was all hunky-dory and things were going well. So I think there needs to be fundamental change in how we approach the financial services industry. The boards have to realize what their responsibilities are, the regulators, the management, of course, has the primary responsibility. And there are institutions where this is not being done. Last point on rating agencies, because that came up. In the subprime crisis, in my little research which I did, primary responsibility, of course, was management of banks, but the rating agencies played a very important role in creating this big monster called subprime crisis. I believe more needs to be done to control them and manage them and make sure that this is not repeated. And you cannot abdicate risk management to a rating agency. A rating agency should be used as a second line of defense. In the boom years, when assets were being created over, the focus was to abdicate risk management to the rating agency. If they rated AAA or AA, we accept it. Nobody did due diligence the way it should have been done. Exceptions are always there, of course.
Joseph, I've heard you say elsewhere that while some banks may have been venal, predatory, mistaken, pushed the limits too far, it is worth remembering that not all did. So, I mean, when you hear this description of how the financial system behaved, the financial industry behaved during the boom years, it's familiar to you because you've heard it before, I know.
I heard it many times, and I still don't believe it. The problem is much more fundamental. We have moved from a very simple bank-based model to a market-based model. And for the first time, we had 3 or 4 criteria which were new. First, we are living in a securitized world,
right,
no longer in taking deposits and making loans. Secondly, a securitized world is a globalized world. You have the same securities, subprime securities now somewhere in a state in Germany or in Spain. Thirdly, it is an atomized world. You have not 20 banks sitting around the table and deciding about whether we should keep the lines open. You have a completely different market behavior. And then something which we clearly underestimated as an industry is the impact of the global imbalances. It is the impact of the shadow banking. And of course, what we really did not expect is drying up of liquidity in a very high liquidity environment. But let me say that, I hear all this criticism of banks. We are talking about 10 or 15 large banks. All the others did fine. I mean, Deutsche Bank didn't take 1 penny from the government. We had very strong results during the crisis. We created jobs and so on and so on. So, and this is true for many European banks, for all the Asian banks, for many Latin American banks, Canadian banks, Australia. You could go on.
Actually, South Africa.
It is. That's why we have to be a little bit more analytical in what we are saying. Now, having said that, yes, banks made mistakes, and we had to learn, especially the leverage. If you boil it down to a simple word, the whole crisis is debt, debt, debt. Absolutely. Debt of households, debt of banks, we call it leverage, debt of sovereign of countries. And we have to start living not beyond our means. And if we can control that, and that is what is happening now. By the way, banks have learned the lesson quite quickly. We have increased our capital ratios from a low level to a pretty high level in the industry. And that shows that we have learned the lesson very quickly. And that's why to talk about failure and morale, and it's all fine, but it doesn't really capture the fundamental issues of banking.
Dick, as someone who's kind of come back into banking full time, though of course you were on the board of Citi for many years, do you get a sense that the people that you're now working with full time genuinely want to learn in a serious way, want to kind of learn the lessons of what's happened in the last few years?
The answer to that is yes, but, right? And I was sitting here reflecting on the only advantage of being old is that you've seen a lot of things before, right? And I ran a thrift institution back in the late 80s, early 90s, and we went through what was called the thrift crisis.
Right.
500 banks got wiped off the board, and it was a major, government had to come in and bail us out. And I've thought about, well, what was the difference between this crisis and the last? Or for that matter, the one that was 20 years before that, or the one that was 20 years before that. The difference is twofold. One, all the people who went through that one and learned something from it are now, like I was, happily retired or moved on to something else. And there's a whole new cast of characters who've taken the field, right? And wisdom does come with age and experience. You're not, no one's born wise. You can have judgment, but you're not born wise. But the thing to me that we need to focus on is the difference between that last crisis. You say, that was contained within banks' balance sheets, right? You made loans, you put them on your book. And if everything blew up because bankers are to some extent lemmings, if everybody's making this kind of loan, we all want to make it if they're making money. But when things blew up, it blew up within your balance sheet. Now, because of technology, you talked about derivatization and the way in which we can make loans and now spread them around the global investment community. That technology, frankly, was what accounted for what Meredith was talking about. A lot of bank, not just CEOs, but department heads, they really didn't understand. And in fact, if you really try and get under one of some of these complicated derivatives, no one can understand exactly what the credit risks are. I remember talking to Warren Buffett once, and he said, the reason I don't buy any of this stuff is because I'd have to read 750,000 pages of disclosure to understand what's in there. I don't have that kind of time. I think that it's the combination of sort of human exuberance. I'll put it that way. I mean, we aren't going to change as people globally. Everybody, you know, if you had to pick one word that would sort of summarize the human ethic, the word I would pick is more. Everybody always wants more. They want more for themselves, they want more for their kids. That's just the nature of the beast. And you combine with that the fact that technology is moving so fast and we can create things that nobody understands. Therein is the problem. It's not, I mean, could we use more wise people? We could use more wise people in every endeavor I know of. Are we likely to get them? Probably not. We're going to have to create systems that appreciate the impact, the influence of complexity and technology to harness and restrain this natural human tendency for wanting more and for always getting, I mean, you're right, 100% right, it's all about debt. But what's debt about? Well, I want more, and I don't have, so I'll borrow. And we've got to learn to get a better balance of that. Risk cannot be obviated by technology. We convinced ourselves it could.
Nick, go ahead.
Yeah. I think we should also recognize that there's a lot that governments can do to manage risk better. I mean, it's nothing new that people are driven, or many of them, to try to do the best they can on various dimensions. I would differ with you, actually. It's not just on material well-being. A lot of other drives and a lot of other dimensions that matter
I want
a great
more
deal.
Everything.
Yeah. Well, we can... it's not a confessional.
This is a man who makes some great wine.
Yeah.
I should say.
The point I wanted to make is that governments were riding on the back of this boom in a very short-sighted way. And I say that as someone who spent 3 years in the UK Treasury from 2003. The governments thought that those revenue streams that they were getting from the financial sector were just on a trend.
Sure.
It's the old story. I mean, we used to, in Europe, criticize Latin America for thinking that every upward blip is permanent and every downward blip is temporary. Yeah. But that's exactly what a number of governments did do. The Spanish government was making a tremendous amount of revenue on the turnover tax on houses. Because there were taxes on housing transactions. So 3 years or so ago, in Spain, there was a surplus. the UK government was acting as if the big revenues they were getting from the banking sector were permanent, indeed rising. And why then do we go into this in Europe with very big structural deficits? Complex, a mixture of reasons, but one of them is gross overestimates over the medium term of what they were going to get from the relevant kinds of taxes on housing turnover, banking, and so on.
Meredith and Joe.
I just want to add that a lot of this is self-regulating, because the problem was you had to feed the beast of securitization because there was demand on the investor's part. So you overextended almost every American and put people, the subprime household, this is not just a household, but in credit cards. Remember, your cat could get a credit card throughout the better part of this the past 10 years. That's over. Party's over. The securitization market is all but closed. And the growth, and I'm sure if you ask everyone here, the growth is not in the debt-laden parts of the world. They're delevering. They're going to continue to delever. Your best opportunities are in emerging markets that are inherently unlevered. And so from an individual standpoint, their relationship with banks will probably not be as debt-focused as they had been in the last 20 years. So the banks that capture that idea and move forward from that are the ones that are really going to gain tremendous market share over the next 20 years.
Joseph.
Well, I fully agree with Dick about good judgment comes from experience. Experience comes from making mistakes. So we need some experienced people, and to fire everyone who is 40 and made a mistake is wrong, as I did yesterday at the panel. On the other hand, if you have only wise men around, I would just like to say something also to emerging economies. We also need an entrepreneurial spirit. And the more we restrict banks from lending, from doing business, from opening up securitization market,
pushing the envelope.
we will slow down the real economy. And we should also talk about trade-offs and opportunity costs. Yes, we had tremendous losses now, and we had a tremendous slowdown in the real economy. Was it really only because of the financial crisis? I think there were more fundamental underlying issues on top of that. But I think we have to go through that correction phase, which is all fine. But we should not forget that we need a strong global financial sector to support real economy on a global scale. And that is also something we have to optimize going forward.
Shogun, come in quickly, then I'll see if I can get a couple of questions.
Two quick brief comments. One on the concept of risk management, which we haven't talked about. Systemic risk is something which in this crisis, I believe we did not give enough time for. So risk management has to cover, when you look at the world, we are a globalized world, as Joe said, and I totally agree. Banking has also changed. Securitization, new products, exotic stuff. It's not just lending. In fact, many institutions survive with no lending, and that can be done. Having said that, the linkages are very strong. So if, say, US banks have a big problem, it affects the whole world. And that's why systemic risks are very important in a geographic sense and in terms of what risks we take. Secondly, I think the concept of deregulation and liberalization comes up. This is something, when I was in government, was the cornerstone of our economic policies. However, I discovered even in a country, developing country like Pakistan, that some people thought deregulation meant abdication by the government. Deregulation puts more responsibility on the government because you don't have the traditional tools to say no, but you have to be alert and you have to have knowledge of what's happening. So it's not just a guard at the door. You really have to know what's going on. So this is a paradigm shift for governments too. So institutions have to change, we all have to change, and the governments, the responsibility of them is very severe and they don't usually have the skills.
Joseph, quickly.
Just one word which, to echo what you said, or what I think implicitly said, is very important. There is a big problem in the financial industry, and that is called interconnectivity.
Sure.
Why is a bank which is too weak to survive a problem for the others? And we have to find ways that failed banks can exit the market as they do in any other industry without jeopardizing or putting at risk the other banks. And this is the major problem we have.
Let's go to the floor for some questions. We've got a stellar panel Gentleman right here, a microphone on its way, and lady at the back.
My name is Karl-Heinz Essler. I'm from Vienna. The bank gets blamed from the public because of the huge bonuses what you are paying to your managers, you know. And what they are blaming is that the managers get bonuses when everything goes good, you know, and if the bank lose money, you know, the managers don't have to pay the money back, you know. They get only bonuses when everything goes up. That's the first. And the second is the huge amount of bonuses, you know, what you pay to your managers. Okay. It is unbelievable. I'm a businessman, you know, and I cannot understand how much bonus you pay to your managers.
Dick, I imagine you've heard comments about compensation structures in the financial services industry before.
Well, every time I have a conversation with anybody, but my favorite congressman always says to me when I try and explain the system, he says, but Dick, you have to understand the people are angry. And I'll report when I get back to the US that the people in South Africa and Vienna are angry. It's a problem. Was it the problem that precipitated the crisis? I don't think so. But it's something that came to light out of the crisis that strikes people around the world as wrong and balanced. That how can you have a system where heads I win, tails you lose, is how most people have internalized compensation. I would say this, that on the one hand, this is a business that, financial services business, particularly on a global basis, that is a true knowledge worker business. I mean, the quality of the people you can attract and the depth of their understanding and expertise in these markets is key to your success. So you need to be competitive in a competitive marketplace. And in that sense, it's always struck me as odd that some areas, like sport, you're here on the eve of the World Cup, and you look at what some of these soccer players make, and nobody seems to have a problem with that. But it's because it's a competitive marketplace and it's a capitalistic structure. That said, I think what we're trying to do at Citi is go back and look at two things in particular. One, are our compensation schemes and programs alert to the fact that we don't want to incent imprudent risk-taking. In fact, we want to disincent imprudent risk-taking. And so compensation is a big part of that. And two, it's a long-term gain. What looks like a gain today may evaporate over time. So the compensation structures need to be extended so that you see how things that are put on the books today perform over time. And if in fact they don't perform well, the compensation isn't there. And then we're putting in things like clawback so that you can go and get some of the money back, although that really falls way down the line as far as I'm concerned from the first two. One, make sure your compensation systems incent prudent risk-taking, not imprudent risk-taking. And two, make sure they're over a period of time where you can evaluate the activities and what's been put on the books. Those were two deficits we didn't have.
Both Showkat and Joe want to come in, but I'm desperate to get just one more question in because we're getting very, very close.
Hi, thanks for the opportunity. We're here at the Global Forum talking about new global opportunity. We're in a session talking about global finance power shifts and the new money game. And, you know, I think that it's important for us to analyze the crisis and how it came about and its implications. But I think for us here in Africa, it might be nice to end on a note where we talk about mind shift, we talk about innovation, and we talk about investment capital. And I'd particularly be interested in hearing Rob's view about going forward, you know, whether or not he thinks, I know that banks aren't, you know, commercial banks aren't development banks, but, you know, whether or not we are going to be wiser in figuring out how do we invest differently and how do we actually shift some capital in places where it's going to make a difference.
Nick, come in.
Yeah, I think that is the right way to end. And Joseph, just a moment ago, turned our thoughts from the money economy to the real economy. And I think we have to ask ourselves the question, as investors, whether we're running a pension fund or a big bank or whatever, where are the big growth opportunities in this next 2 or 3 decades? Well, first is that we're right at the beginning of a new energy and industrial revolution. And we have to think about, as bankers, about how to take those opportunities. High carbon investment is going to be very risky and getting riskier. Low carbon investment is risky and getting less risky. And that's where the story goes. The second thing is to look at the parts of the world that are growing.
Right.
Africa's been growing at 5 or 6% real for the last decade. It dropped just slightly down to about 2.5% last year. It's probably going to be back to 5% this year. Africa is one of the great investment opportunities. I think India and China are also going to grow very strongly, but I think right here in Africa is something that people should look for.
Everyone wants the last word, but Meredith's going to have it. But Dick and Showkat can have very short last words.
Well, I'm just going to say on something Nick said. I think one of the reasons this is an exciting time to be here is because it really is, again, exposing what's going on in Africa. There are a lot of myths about it and just misunderstandings, certainly in the U.S. and I think to a lesser extent in Asia about how dynamic things are here. But in order, it's not just the banks. It's not just going to be, particularly foreign banks, or even the World Bank type aid givers. I think Africa has got to, in all the African nations, pretty good shape here in South Africa, but the rest of Africa, focused on the infrastructure that's going to enable domestic investment. Because you can't ask others to come in and invest in your markets if you're not investing them in yourself. And if you don't have the infrastructure to create vibrant capital markets, you're not able to invest in yourself. And if I had one message to leave, that would be it, that the linchpin to all this is creating vibrant domestic investments in these growing economies. And the linchpin to that is creating the infrastructure that's going to enable it.
I will just make one comment. For the real economy to grow, and Africa, as was said, has great opportunity. Think of microfinance to touch the masses, SME lending for the middle market and the people who are just starting, and of course the normal banking structure will take care of all the larger businesses. We need infrastructure where the development banks have to do their part. World Bank, African Development Bank. At the same time, this will only work when the governments in Africa continuously reform, show good governance and transparency.
Meredith, last word.
It's a really positive note. President Clinton spoke about it yesterday. Tom Freston spoke about it today. The concept of Africa being a wireless continent. Africa is very much on the radar screen of non-bank banks. Nokia comes to mind in terms of empowering consumers through the use of mobile banking. And I think Africa will be a leading continent in mobile banking, and that will enable moves into microfinance, into the evolution chain up to what is traditional capital markets banking. But it's already on the radar screen, and I think you look around and you'll see it all around, and that's so exciting.
Meredith Whitney, Nick Stan, Showkat Aziz, Joseph Ackerman, and Dick Parsons by El Boss, who let the record show, told us that we should be doing a global forum in Africa 4 or 5 years ago. So my hat off to him. Thank you all very much. Absolutely fabulous panel. Thank you.
Can we please?